All right, today we're going to tackle something that can seem, incredibly complicated, financial statement analysis. But what if I told you it's really just like giving a business its annual medical checkup? That's the lens we're going to use to make sense of it all.
Because this is the big question, right? You open up a company's report, and you're just hit with this wall of numbers. It can feel pretty overwhelming. But buried somewhere in all that data is a clear answer to whether a company is thriving, just scraping by, or maybe even on life support. Our job is to figure out how to read those signs.
And don't worry, we've got a roadmap. First, we'll frame this whole thing as a financial checkup. Then we'll look at the patient's 3 charts. Those are the core financial statements. After that, we'll grab our doctor's tools to analyze them. Then we'll put it all into practice by diagnosing a company's health, and finally, we'll deliver the final prognosis.
Okay, so let's dive into Section 1, the financial checkup. This is all about shifting your perspective. We're not just number crunchers here, we're more like financial detectives or doctors, looking for clues to piece together the real story of a company's health.
Think about it this way. A doctor doesn't just look at you and guess if you're healthy, right? No, they run tests to get your lab results, they look at the charts. Well, financial statements, they're the exact same thing for a company. They give us the hard data, the vital signs we need to make a real, objective assessment.
So what are these lab results? That brings us right to Section 2, the patient's 3 charts. Just like a person has a medical chart, a company has a set of core financial statements. And there are 3 of them you absolutely have to know.
First up, the balance sheet. The best way to think about this is like a photograph. It's a snapshot capturing a company's financial position on one single day. On one side, you've got everything it owns, its assets, and on the other, everything it owes, its liabilities. What's left over is the owner's stake, or equity, and the clue's in the name, these 2 sides must always balance out.
Now, if the balance sheet is a photo, then the income statement is a video. It doesn't show you just one moment in time, it shows you the action over a whole period, like a quarter or a full year. It's the story of money coming in, money going out, and that all-important bottom line. Did they actually make a profit or not?
And third, we have the cash flow statement. Now this one is so important because making a profit on paper is not the same thing as having cash in the bank. This statement is the ultimate reality check. It follows the actual cash as it moves in and out of the company from its operations, its investments, and its financing activities.
Okay, so we've got our patient's charts, but they're still just a bunch of numbers. How do we actually interpret them? Well, welcome to Section 3, the doctor's diagnostic tools. The most powerful tools in our medical bag are what we call financial ratios. They're what help us make sense of all this raw data.
And using them is a really simple 3-step process. Seriously. First, you just find the key numbers you need from the statements. Second, you plug them into a formula. And third, and listen, this is the most important part, you compare the result. A number all by itself means almost nothing. You have to compare it to how the company did last year or how its competitors are doing to get any real insight.
And these ratios help us check different kinds of health. So, liquidity ratios, they're all about short-term health. Think of it like asking, can the patient pay its bills this month? Does it have enough cash on hand? Solvency ratios, on the other hand, they're looking at the long term. Is this patient fundamentally strong enough to survive for years to come? And of course, there are other vital signs we need to check. Profitability ratios, well, the name kind of gives it away. They tell us how good the company actually is at turning sales into real profit. And efficiency ratios show us how well the company is using its stuff, its assets, its inventory to make those sales. Kind of like checking the patient's metabolism. All right, theory time is over. Let's get our hands dirty. It's time to put on our doctor's coats for Section 4 and actually diagnose a patient. We're going to use a simple, fictional company we can all wrap our heads around, the Daily Grind Coffee Co.
Here we go, these are the lab results, a simplified income statement. You can see their total sales or revenue came in at $500,000. The cost of all their coffee beans, milk, and cups was $250,000. And after you factor in all the other expenses, like rent and salaries, their final net profit was just $10,000. So, what does that tell us?
To figure that out, we need to check the company's pulse. And for that, we use a key profitability ratio called the profit margin. This thing is so powerful. It basically asks, for every single dollar that comes in the door, how many cents does the business actually get to keep as profit?
So we do the math. We take that net profit, the $10,000, and we divide it by the total revenue, the $500,000. And what we get
is the company's pulse, 2%. For every $1 cup of coffee they sell, they only keep 2 cents as profit.
2%. So is that good? Is that bad? I mean, what does that even mean? Well, that brings us to our final section, the final prognosis. This is where we take our finding and explain what it really means for the patient's future.
Our diagnosis is pretty clear. The Daily Grind Coffee Co. is suffering from a chronic case of low profitability. It's alive, it's surviving, but it is definitely not thriving. That is a weak pulse. And here's why we can be so sure about that diagnosis. That 2% number on its own, it's just a number. But look what happens when we give it some context. Our patient, the Daily Grind, is at 2%. The average coffee shop in this industry, they're at 8%. And the company's own goal was 10%. All of a sudden, 2% doesn't just look small, it looks alarmingly low. See? Context is everything.
So, as the financial doctor, what's the prescription? Well, we could suggest a treatment plan. Maybe they could raise prices on some of their fancy drinks, or implement a loyalty program to boost sales. On the cost side, they could try to renegotiate with their coffee bean supplier or take a hard look at their utility bills. This is how a financial diagnosis leads to a real-world business strategy.
So if you take just one thing away from all this, let it be this. Financial statements are not just boring accounting documents filled with numbers. They are a narrative. They tell a rich, detailed story about a company's health, its challenges, and its potential. You just have to know how to read it.
And that leaves us with one final thought to chew on. We've just learned how to read the story that the numbers are telling us. But the mark of a real expert is to always ask the next question. What about the things these numbers don't tell us? You know, things like the company's amazing reputation, or their fantastic employee morale, or that brilliant new CEO they just hired. That's where the art of analysis really begins.